Good morning, everyone, and welcome to this special webinar focusing on oil. All the Refinitiv team is happy to be in live with you today. So to introduce myself quickly, I'm Katie. I'm a customer success manager for commodities, and I'm in charge of clients based in France. So before to start, a few words about the rules for this webinar. So if you have a question, don't hesitate to write it in the box, and we will answer at the end of the presentations. Okay? So the agenda. During this session, we will discuss about the evolution of the COVID pandemic and its impact on supply and demand. Have the supply cuts from OPEC been pushed too far? How have the major supply centers contributed to the recovery in demand, among others? And we will end with a Q&A session. The speakers of the day, so I already introduced myself. We will welcome Ranjit Raja, the Head of Oil and Shipping Research, Middle East, Africa, and Yoyan Chong, the Director of Oil Research for Asia. So let's start with the first part. Ranjit, it's yours.
Thanks, Katie. Hello, everyone. Good morning, good afternoon, good evening, depending on where you're joining us from. And thanks for taking the time to join us today for this webinar. For the next about 20 to 30 minutes, I will be looking more into the oil markets, a little bit into the look back of the year, into how the year has performed for the oil markets, and what is expected in the near to short term in the next few months going ahead, but more from a supply perspective. And following that, I will have my colleague Yoyan Chong, who will be looking more from the demand side of things and will be taking a look into the consolidated supply-demand dynamics. So to start with, we cannot escape the presentation without a little bit of touching on the COVID snapshot in terms of looking how the COVID pandemic has been evolving over the past few months and how it has been kind of impacting into the supply side of things, and more importantly, the demand side of the aspects for the global economy. To start with, in the current global COVID cases stands roughly at about 248 million cases with an estimated 5.2 million deaths. The October case count is estimated to be the lowest in the past 4 months, and which basically indicates roughly at about slightly lower than about 13 million cases. And what this essentially means is that we could potentially expect a subsiding infection rate globally, and presumably the end of the third wave as what we have been expecting or looking at in terms of the global markets. The US still accounts for the major cases globally, roughly at about 46 million cases, followed by India with about 34 million cases. And what's more interesting here is the two charts on the right, where it shows how each of the wave has spanned, both in terms of the numbers and in terms of the time frame, and who have been the major contributing countries accounting for these cases. So without a doubt, the first wave and the third wave has been dominated more from the cases from the US, whereas the second wave, which was the start or emergence of the Delta variant, was based mainly from the cases out of India. The UK has also been quite a considerable factor in terms of the cases that has been accounted globally, but more of concern is basically at the end of the third wave. If you look at the chart on the bottom right, we can see a small blip or a spike starting to emerge towards the end of October or early November, where there has been starting to see a slight increase or uptick in the cases that has been reported globally. And this is primarily expected due to the resurging cases that has been reported out of Asia, and also a little bit of partial lockdowns that has been announced, which is expected to play a role into the upcoming demand side of things as well. In terms of the vaccination rates globally, that has played a huge role in curtailing the spread of the virus so far. And unfortunately, there has been a huge disparity in terms of the percentage of the population vaccinated out of the advanced economies and the developing economies, if you look at it. So UAE and Portugal lead the vaccination rates globally. They have more than 86 to 87% of their population vaccinated with both the doses. while globally, if you look at it, it's just about 48.5% of global population that have got administered with just a single dose of vaccine. A total of about 6.8 million doses have been administered till date, with the daily vaccination rates hitting about 25 million doses. So this is expected to play a huge critical factor in terms of determining how the demand is expected to kind of proceed from here on, and how that's going to play a huge role in terms of the volumes that are expected to come on. And a look into the supply perspective, more in terms of the benchmark crude prices. So the benchmark crude prices has been extremely bullish, especially with October month has been extremely good for the bulls. And this has been due to several factors, which we will discuss shortly. But in terms of the prices itself, I think the $80 threshold was kind of breached sometime in September, and it hit, and it also went on to reach a high of about $86.4 towards the end of October. And this was as expected, because we were expecting the resistance levels to start hitting somewhere around the $87 per barrel mark, and that's exactly where we saw a slow dip into the price markets, and the highs that it reached at $84. Some of the factors that has been contributing for this particular bull run is primarily due to the extended outage following the Gulf of Mexico power outages that went on. The OECD demand has been outperforming, and the pandemic risks kind of spooked the market back in August, but it didn't fail to materialize as expected, so the demand was much better than what was anticipated. The OPEC capacity has been long discussed, and it has been kind of clearly identified by the group that they would stick to their initial deal of ramping up only by about 400,000 barrels per day and nothing more, which has kind of shaped in terms of the available oil versus the demand that is expected from the market. And more importantly is also the capability of some of the OPEC producers in terms of ramping up their production levels to meet the demand as and when expected. So we will look at the compliance rates and the production levels like a few slides down the line, but it is quite clear there some of the producers are actually struggling to meet even the allocated quota of volumes that has been given to them. And the spare capacity is also something that we will be tapping into, because that determines the flexibility of the upstream more in terms of what can be tapped into the potential for the volumes to be brought in and made available to the market as and when needed. And not to mention, recently there has also been a huge surge in terms of the LNG prices and the shortage of thermal coal for power. And that has also catered or factored into the bull run for the oil markets that we have seen in the last couple of months. The second chart here is basically the Brent WTI spread, which has been narrowing significantly since September. And at one point in October, it reached less than $1, which was like kind of the levels that we last saw only around May 2020. And this is primarily expected due to the tightening market in the US, where the Cushing inventories kind of declined and went to just about 30 million barrels or even lower right now. And this has this has basically have made the prompt time spreads to strengthen significantly, and the prompt WTI spreads trading at a backwardation of roughly about $1.4 per barrel. And with the Dubai Brent spread for October continuing to recover, the spread reached a high of almost about $4.6 or $4.7 per barrel, which is again levels not seen before since June 2014. And this is primarily because of two cases. One being the factor that the African producers primarily not being able to reach their allocated production quota, thereby making the Middle East crude more attractive, or basically making the Middle East crude the default or the preferred crude in order to meet the recovering demand or the increased demand that's coming through. And this could also be one of the major factors why we have seen the EFS climbing up significantly, especially in the last couple of months. So the next is primarily to take a quick look into the supply-demand balance, which has kind of based out of the short-term outlook from the EIA. And what this essentially means is by comparing the 3 months back or side by side, or which has been announced from August, September, and October, it is quite clear where initially the balancing was expected to happen somewhere around Q3 of 2021, which has been significantly revised since, and the transition is not expected to be smooth. And this led to a shortage in terms, or a significant revision in terms of in terms of the supply demand the rebalance that was expected, where the demand far exceeded supply towards the Q3 for the September indications, showing that the rebalancing was expected to happen in Q4 of 2021. But the latest predictions or the latest numbers that has been given indicates even in Q4 2021, the demand is going to far exceed supply, and the rebalancing is expected to only happen somewhere in Q1 2022. So this revision is basically flipped the narrow oversupply market into a steep undersupply or a supply deficit of roughly about 1.8 million barrels per day. And of course, as we said, some of the factors have been because of the OPEC curtailment, the Gulf of Mexico outages, the hurricane seasons, and the non-OECD countries performing the way that they were not expected to perform. So the September outlook does give an extended period of price bullishness, and the expected rebalance is expected to happen somewhere in the next 3 to 4 months, extending up to the next couple of quarters that we're looking at. So next is basically looking at the spare capacity perspective. And what this essentially means is taking a look at what is the spare capacity that is going to be made available from the OPEC members. So from the chart here, we can see OPEC contributes roughly about a third of the global oil production or the oil supply. And going forward for 2022, the excess capacity or the spare capacity that can be made available from OPEC is roughly expected to be between 5 and 5.3 million barrels per day. And although this comes back into the question of what we discussed previously, where even though the capacity is available, it's going to be more a challenge of making the capacity made available to the market, primarily because of the inefficiencies and the incapabilities of the producers to make those volumes made available into the market. So before we jump into the OPEC numbers, a quick snapshot into the US inventories and the production numbers. In order to kind of give a quick snapshot, the US oil rig count is no longer a clear indication or a reliable measure of the output from the country. The well productivity have increased significantly. The last major dip that we saw in terms of the rig count, it showed a 75% decline in rig count, but whereas the output dropped just by about 25%. And despite dropping production, the exports have been able to be has been sustained roughly about 450,000 barrels per day, and that is primarily because of a major draw from the Cushing inventories that has been happening, which has pushed the inventory levels to below 30 million barrels currently at the levels that we are seeing. So this is also kind of pushed into the bullish factor for the WTI benchmarks, and that is primarily one of the reasons why we are seeing the bullish run in terms of the crude benchmark prices as well. In terms of the OPEC from a supply perspective, the overall OPEC volumes is roughly for October was estimated at about 27.5 million barrels per day, according to the Reuters OPEC survey. And in October, the cuts from the OPEC stood at 2.889 million barrels per day, while bound by the deal, which reduced the output by compared to the 3.4 million barrels per day, which essentially puts the group at an over-compliance category at about 118%. But what is interesting here is that pretty much most of the Middle East countries, Saudi, Kuwait, UAE, all the major producers are just about complying at about 100% of the expected or the allocated quota, which indicates that they have been able to ramp up their production volumes as per what has been expected or allocated to the respective countries. But what is interesting here is to see how the African major or the African countries have been performing, where pretty much you can see Angola, the rate is at about 259%, Nigeria at 191%, and Guinea, Congo, everyone significantly higher. So what this shows us is that even though the allocated capacity is significantly higher for these countries, they have been facing an issue in terms of ramping up their volumes to the expected levels. If you look at the production table, Nigeria has been able to manage their output levels pretty much at about 1.45 to 1.5 million barrels for the last 5-6 months. And it's the same case with Angola, where they've been able to manage just about 1 to 1.1 million barrels per day. So they are kind of struggling at this point in time in order to increase their output beyond those levels. And it will be a question of how easy or how challenging it's going to be for these countries in order to increase or raise their output in order to meet the expected demand that's going to come up in the next couple of quarters going forward. Looking at the OPEC more from an export perspective, the October seaborne exports was roughly estimated at about 19.7 million barrels per day. This is a month-on-month increase of about 850,000 barrels and a year-on-year increase of about 1.45 million barrels per day. And what this essentially shows is how big a contributing factor the Middle East members play in the OPEC group. The Middle East members account for roughly 76% of all the OPEC exports, whereas the African members account for roughly about 22 to 23%. In terms of the seasonal average, which is the chart on the bottom left, that takes into account the monthly averages from 2017 till date and how the current year is performing against it. Of course, the lower end of the spectrum is kind of skewed for 2020, pulling the volumes down since May. But what it shows is that for the 2021 volumes, since May or June, we have kind of doing better than what the 2020 volumes have been doing, and we can start to see a slow uptick towards the September and October export numbers. But in order for the volumes to reach back into the pre-pandemic spectrum of roughly about 30 million barrels per day, that's going to take a significant upward revision, and that is expected to happen in the next 5 to 6 months once all the production cuts have been taken and the exports resumes back into the pre-pandemic levels. In terms of the next one is to more look at from the supply in terms of the volumes that are made available from the Middle East. And this is quite interesting because we did speak a lot about how Middle East plays such a crucial factor or a role in terms of making the volumes available into the market. While Saudi exports did increase considerably, crossing the 7 million barrel per day mark for the first time since April 2020, the exports were assessed at roughly about 7.4 million barrels per day. And there has been quite a significant uptick, or the capability of Saudi comes into the forefront of how good or how capable they are in terms of making the volumes available as and when needed, catering to the demand. In terms of Iraq, we saw the actually the Basra medium grade that was introduced in January of this year. But in terms of the overall volumes, the exports recovered by 180,000 barrels per day last month, and it has been assessed at about 3.24 million barrels per day. This is in line with their increase in production numbers that was expected for October, and the trend is expected to continue going forward as the production volumes increases and also the catered volumes for the markets. But what is interesting here is also to see how their allocation is going to be changing for 2022. Iraq has already, or SOMO has already announced that they are going to be reallocating the Basra Light volumes predominantly for the domestic consumption for the domestic refineries, whereas Basra Medium is going to be the kind of the grade that they're going to be promoting more into the market. So all allocations for 2022 have been asked to be changed to Basra Medium, Basra Heavy, and the Kirkuk blend grades. Even the port configurations and the berth configurations in Basra have already been changed, and the loading schedules and the nominations we are already starting to see the shift from the Basra Light volumes more into the Basra Medium, which has kind of taken over the volumes that were previously allocated for the light ends of the market. In terms of the UAE crude, the exports last month rose by about 70,000 barrels per day. They were assessed at about 2.58 million barrels per day. Japan continues to remain the largest buyer of the Murban grade, and thus followed by China and India, where China considers mostly the upper Zakum grade, followed by the India and Singapore taking the respective chance for those grades. What is also interesting here is almost 98% of the volumes out of the UAE comes from the ADNOC berths or ADNOC terminals, and roughly about 39% of those comes from Zirku. So Zirku is one of the predominant grades, followed by Das and followed by Murban, which account for the major volumes or chunks out of the UAE markets. In terms of looking at Africa quickly, so like we see, African members do play a significant role in terms of the volumes that are pushed out, with Nigeria contributing for about 1.4 million barrels per day. But the challenge, like we mentioned before, has also been how swiftly they are going to be able to manage the expected volumes that are going to be put into the market. So from the North African perspective, we have the two major producers, which is Algeria and Libya, where exports last month have taken a slight uptick, with Libya and Algeria increasing by about 210,000 barrels per day and 130,000 barrels per day respectively. So even though the condensates also form a significant portion of the volumes from these countries, the crude exports, including the condensates, have been slowly seeing an uptick, but not as high as what their expected allocations can be, and they're meeting the demand for the increased volumes that can be made available to the market. And moving into the West African sector, the West African market is a little bit more curtailed in terms of the volumes or the fluctuation in terms of the volumes that are being made available. It is quite clear that the volumes out of Angola and Nigeria are more catered to the Asian markets and the Mediterranean markets, which we will see a little bit more into the next slide. But like we mentioned before, the volatility is an ongoing concern for the volumes out of Angola and Nigeria. So Angola had the largest drop of about 370,000 barrels per day last month, while Nigerian exports dropped by about 50,000 barrels per day. But what has been of concern is the volatility that we have seen from Angola, where volumes tend to move roughly by about, say, 300 to 350,000 barrels per day, while Nigerian exports tend to range between 50 to 100,000 barrels per day, with the exception of August, where they did move drastically by about 250 to 300,000. But the one major factor that we need to consider going forward for 2022 is also going to be the Dangote refinery in Nigeria, which is expected to come online, which was expected to come online this year, but due to the COVID pandemic and the delays that have been happening, it has been pushed to the late part of next year. And what this is expected to do is take out a significant portion of Nigerian crude out of the international market and to be catered for the refinery domestically to cater for the domestic product demand. And this is all going to be, the impact is going to be twofold. One is the Nigerian crude made available to the international markets, but also a drop that is expected in terms of the products that are imported into Nigeria, especially the light and the middle ends, which are currently imported all the way from Europe. So that will be one of the major shifts that we could expect going forward in 2022. So this is basically a quick snapshot into seeing which are the major countries that take a significant portion of the volumes from the respective African producers. Like we mentioned, China, it's mainly catered significantly from Angola, followed by Congo and Libya, and India is significantly factored from the Nigerian grades that are being pushed there. In terms of the Mediterranean markets, Italy and Spain form the major chunk, with Spain being catered by the Nigerian crude and Italy being catered mainly from Libya due to the proximity that's being made available. And of course, we cannot wrap up the supply side of dynamics without a question that is it keeps propping up into the headlines once every few weeks or months, which is basically how Iran is going to play a huge role in terms of the volumes that are going to be made available. So there has been a significant shift in terms of the discussions and in terms of the timelines that have been discussed into the markets. The sanctions were put back in place by the US in November 2018 after withdrawing from the JCPOA in May 2018. And following that, there have been significant developments both in terms of the US political system and also the Iranian political system, where the presidents have changed, the negotiations have resumed, although there is still no end in sight in terms of when the sanctions are expected to be lifted or how it is going to play an impact. The discussions are certainly ongoing, and the feedback has been quite positive in terms of the headlines that the aim of the negotiation is to try and find a deal in order to bring Iran back into the international markets. And in terms of looking at how that's going to play a role in terms of the volumes made available, we are looking or taking the volumes from an Iran's perspective only when the sanctions were lifted and when the wind-down period was allowed, because the current tracking or the current indication of the Iranian volumes is highly volatile from one agency to the other, with volumes ranging anywhere from 250,000 barrels per day to 750,000 barrels per day. But if we look at the pre-sanctioned volumes, we can expect an increase of at least 1 million barrels per day if the sanctions are lifted and if the Iranian barrels are made available to the international markets. The current production levels from Iran stands at roughly about 2.48 or 2.5 million barrels per day. And we did see the pre-sanction era where volumes were holding at about 3.5 to 3.8 million barrels per day, which also means there could be an additional 1 million barrels per day that could be brought into the market just by Iran. In terms of the destinations or the major markets for Iran, it's primarily China and India, which together contributes for more than 50% of the volumes out of Iran. So this too would be the primary target markets if and when they do come back, which would also put a huge question or challenge for both the West African producers and the other Middle Eastern producers who are currently catering or compensating for these volumes from their perspective. Finally, just a quick snapshot into the current floating storage and the freight markets. Floating storage volumes have been declining from the highs that we saw towards the end of 2020. And currently for the VLCCs, we see the volumes ranging at about 40 million barrels. And with Suezmax, roughly between 15 to 17 million barrels, although with catering with the potential floating storage, which is still not completely factored in as floating storage because of the time that they have spent idle, we could see a small revision towards the volumes that are kept aside. But in terms of the freight, though, we can see a clear shift starting from end August, early September, especially for the Middle East grades and for the West African grades. And this is primarily due to the demand recovery that we have seen in terms of the Asian markets and also the increased supply that has been coming out of OPEC. So as and when the market progresses, if more volumes are being made available, then we can expect the freight rates to also push up in order to cater for this increased demand that is existing in the market right now. So with that, I will close down the supply perspective and I will hand it over to YC and Chung to go into the demand side.
Right. Thanks, Ranjit. Thanks a lot. First, I apologize for not having a video. There's some technical problems here. Hope you don't mind. So but you can hear me, right? Yeah. So before I start, I'd just like to sort of give a quick introduction, on what we do as in both Ranjit and myself. We are part of this larger commodities research division that was established in 2011 when we were still sort of Thomson Reuters, right? And it's part of the company's strategy to provide what we deem to be exclusive content. This division today is made up of over 150 analysts across the three major commodity asset classes, being energy, which encompasses oil and power and gas, oil in which we sit, agriculture and metals, each with their own team of analysts. Our oil team basically has about 30-odd analysts today in Singapore, Dubai, London, and Houston, and we produce what we call near-term in-depth analysis of supply, demand, fundamentals by product, by region. So, for instance, if we are talking about the Middle East, we are talking about crude coming out of the Middle East, for example. And if we're talking about Asia, we're talking about crude coming into Asia. Okay, and obviously then we are measuring flows coming into Asia, for example, and we do benchmark them against official numbers wherever possible. And generally, our accuracy benchmarks are fairly high. It's above 90% for most of the forecasts. For example, for crude into China, we are sort of 99 to 100% versus customs. For gas oil coming out of East Asia, we are about 85 to 90% versus customs, and naphtha going into East Asia, we are about 90%. Just an example. Okay, Ranjit has taken you through the numbers. I'll just flash them again briefly. We have had now almost 248 million infections and over 5 million deaths in 211 countries. So, while things are still, things seem to be looking brighter, but the pandemic is still well with us. And a snapshot of the current oil markets, again, Ranjit has probably mentioned this, so I'll be brief. Oil prices have surged above $80 a barrel, and this is buoyed by largely bullish sentiment over this growing power shortage across the world, and as we head towards the peak demand winter season. Amid the reluctance of OPEC Plus to, or at least the perceived reluctance of OPEC Plus to raise output beyond the agreed 400,000 barrels per day for each month between August and April 22, which will take production to a target of 38.9 million barrels per day, which is the highest post-pandemic level, though crucially still well below the pre-pandemic Q1 average level of 41.46 million barrels per day. And despite this bullish price environment, demand in Asia remains lackluster up to Q3 at least. Crude imports for Q3 2021 average at 94.6 million tons per month, down from even H1 2021's average of 98.69 million tons per month, signaling that the power crisis up to this point at least has not led to an increase in refinery runs. The lower imports were mainly due to China's curbs on excessive output of refined products since June in particular, and by its mostly by small and medium-sized private refiners, while India, Korea, and Japan remain still under some form of movement control, though we seem to be getting out of it through October towards the end of the year. Okay, let's look at each country individually. So if you look at China's crude imports have fallen sharply since April, averaging at about 10.3 million barrels per day between April and October, versus the Q1 average of 11.31 million barrels per day, and the 2020 average of still lower than the 2020 average of 10.78 million barrels per day. Initially on seasonal Q2 maintenance, then followed by the government's curbs on excessive product output that came into force in June. October imports, however, are assessed at a 7-month high of 10.79 million barrels per day after the final tranche of crude import quotas were allocated. We will talk more in detail about that as we go along. Refinery runs fell under 90% of the country's above 15.6 million barrels per day capacity for 3 consecutive months between July and September, averaging at 87.42% and hitting a 17-month low of 86.36% in September, well below the June 2020 to June 21 average of 91.29%, though still well above the 2015 to 19 average of 79.42%. And as we all know, China's refiners are governed by the basis of this crude import quota that is allocated by the government. And in line with the government's move to curb output, the import quota for private refiners this year is only marginally higher on year at 189.14 million tons, after the fourth and final tranche for the year was allocated, versus the 2020 quota of 184.55 million tons. And this is despite over 700,000 barrels per day of new capacity coming on stream by the end of this year, with 400,000 barrels per day already online at Zhejiang Rongshen's petrochemicals plant that brought its total capacity to a massive 800,000 barrels per day. Another sort of about 300,000 barrels per day of capacity is expected to come on stream before the year end when private refiner Shenhong's refinery comes online. Okay, and as part of China's measures to curb output, punitive taxes were imposed from June on imports of the bitumen mixture feedstock, typically a blend of heavy crudes and jet fuel that are favored by the private refiners who do not have crude import quotas. Imports averaged just over 2 million tons per month between May 2020 and May 2021, just before the taxes came into effect, jumping from the 2017 to 19 average of just over 200,000 tons per month, and hit a record high of just over 4 million tons per month in May, as amid this buying frenzy before the taxes came in. And then we've now fallen to well under 1 million tons per month from July onwards. The government has also clamped down on the trading of crude import quotas, a common practice between quota holders and private refiners who don't have quota, as reflected by a move to bar a unit of state-owned PetroChina from reselling crude purchases. And they expect this to have led to a 3% fall in crude imports. How does that translate into yields? Well, despite the low refinery runs at under 90% between July and September, gas oil is at an average of, gas oil yield is actually at an average of 13.09 million tons per month for the same period, above the January to June average of 12.71 million tons, though under the 2019 average of 13.84 million tons per month. Gasoline output is even more spectacular, averaging at 13.38 million tons per month for the same period, and hit an all-time high of 13.74 million tons in July, well above the 2019 average of 11.81 million tons per month and the Jan to June average of 12.35 million tons per month. So it's even higher than pre-pandemic levels. Okay. Jet kero output, however, remains well below the pre-pandemic 2019 average of 4.39 million tons per month, averaging at 3.12 million tons per month for July to September, and culminating in August's 16-month low of 2.8 million tons, well below the Jan to June average of 3.81 million tons. So what kind of conclusions can we draw from these numbers in China? Okay, so now we look at the product yield as a percentage of the total products that it processes. Gasoline use hit 31-month high of 30.12% of the total refined product output in July, well above the first half 2021 average of 27.16% and even the 2019 average of 28.33%, and is averaging at 29.96% till September. Similarly, gas oil use averaged higher at 23.27% for the same period, above the first half 2021 levels of 22.18%, but under the 2019 average of 26.32%. Despite the surge, output for both products remain well under 2015 to 18 levels of above 30%. And this is largely due to the new mega refineries that have come on stream from 2019 and have focused their output mainly on petrochemicals. It is likely that this trend will continue going forward with more petrochemical-focused capacities coming online, not the least the 320,000 barrels per day Shenhong plant that we have talked about, which will have petrochemicals as 65% of its yield. And the higher, we believe the higher, but at the same time, we have seen that product yields are high, right? In fact, gasoline at record high level. So we believe that this higher product yields resulted from the government move to impose punitive taxes on imports of light cycle oil, which are typically used to blend gas oil for the domestic market, and mixed aromatics, a gasoline blending component, creating a supply vacuum within the domestic market. As a result, exports for both products fell despite the record high yields from July, with exports of gasoline as a percentage of output averaging at 5% between July and September, versus the first half 2020 average of 12.66%, while that for diesel fell to an average of 7% versus 17.02%, with most of this output kept to meet domestic demand. And domestic demand has largely recovered to pre-pandemic levels since June 2020. On top of imposing these punitive taxes, China has clamped down further on output by slashing export quotas, allocating only about 37 million tons for exports of diesel, jet kero, and gasoline together. This is the lowest export quota since 2015 and well below 2020's 59.03 million tons in two tranches so far. This was on the back of the lowest tranche 2 allocation of just 7.5 million tons since 2017, though we are still expecting one more tranche. May come, may not come. Up to September, about 91% of this quota has been consumed, meaning that there are just 1.05 million tons per month of exports left until December, if no fresh quotas are given. and compare this against the 2019 average exports of 4.28 million tons per month, where 99% of the quota was consumed. So no surprises why China is not exporting. Right, let's talk about India. Okay, and from a crude import perspective, or rather, let's look at refinery runs. India runs remain under the 2015-19 average of 98.15% of its 5.1 million barrels per day capacity, averaging at about 87.45% between May and September, but are expected to rebound in October, as was the case last year when runs rose to post-pandemic highs of 99.1% between November and January, following the end of the monsoon season and the advent of the festive Diwali season, which is happening around now. And amid this worsening pivot crisis that has forced some industries to look for alternative energy sources, typically sort of small diesel power generators. Crude imports jumped to an 8-month high of 4.51 million barrels per day for October, rebounding strongly from the May to September average of 3.89 barrels per day and steady versus the post-pandemic average of 4.49 million barrels per day, reflecting the expectations that runs will rebound in October. And how does yields look for India? Gas oil output is also expected to rebound strongly from September's 12-month low of 7.83 million tons, when demand was curbed by the monsoon season that has since ended and is expected to head towards the November-January average of 9.66 million tons per month, lifted both by the festive season optimism and power generation demand amid spiraling coal and gas prices and shortages of both products to utilities. Similarly, gasoline output is also expected to rise from the April-September average of 3.08 million tons per month towards pre-pandemic levels of 3.2 to 3.3 million tons per month, with all movement restrictions ceased in India. Jet carrier output, however, remained well below the 2019 average of 1.56 million tons per month through the entire post-pandemic period, falling under 7-month lows of 800,000 tons per month between June and July, but despite seeing an uptick of 950,000 tons per month between November to March 21. And in conclusion, okay, so from India's perspective, gas oil production averaged about 42.81% between June to September, up marginally from the May to May average of 42.56% and 42.5% for 2015 to 19, but fell sharply to 41.02% in Sep. This is the lowest in 96 years. In contrast, gasoline output jumped to an 11-month high of 16.14% in the same month, up from the Jan to August average of 15.46%. We believe that the stronger gas oil output prior to Sep was led by strong export demand, with the ratio of export yield rising to an average of 31.22% between May to August, versus the October 20 to April 21 average of 26%. Outflows west of Suez particularly soared to a record high of 1.24 million tons in Sep. However, the looming peak festive season has led to a surge in demand or domestic demand for transportation fuels, in particular for gasoline, that even saw India importing 150,000 tons of the product in Sep, its highest import since December 2020, and at least up to October another 110,000 tons so far. Okay, let's talk about South Korea. Crude inflows into South Korea also rose to pre-pandemic highs for the first time in October at 2.89 million barrels per day, the highest since February 2020 and above the 2019 average of 2.87 million barrels per day, as the country reached its vaccination target of 70% prompting an end to months of lockdown. Refinery runs are also expected to rebound from the post-pandemic average of 86% of its 3.02 million barrel per day capacity from October, but it will take some time to hit pre-pandemic levels of 97.6%. In terms of yields, the Korean yields are actually quite interesting. Gas oil output eased from June, averaging at 3.76 million tons per month, but versus the 2020 average of 3.9 million tons per month, which actually was above the pre-pandemic average of 3.87 million tons per month. So even during the the pandemic months of 2020, gas oil output was high. In contrast, gasoline output surged from March, culminating in July's 19-month high of 1.77 million tons per month, averaging at 1.76 million tons for Q3, well above the pre-pandemic 2015 to 19 average of 1.61 million tons per month. Jet kero output averaged at 1.64 million tons per month, under the 5-year average of 2.06 million tons per month, but rose May to September, averaging at 1.7 million tons per month, in line with higher runs. And what conclusions can we draw from the Korean numbers? Despite the below average runs, gasoline yields, hit record highs in 3 of the 4 months between June to September, culminating in September's 20.87% yield and averaging at 20.33% for that period, well above the 2015 to 19 average of 16.98%. In contrast, gas oil yields eased in June to Sep, averaging at 35.1% after being at stronger levels of 35.86% between April 2020 and May 2021, including hitting a record high of 37.85% last August. This shows that South Korean refiners had actually focused on gas oil output for much of the post-pandemic period before switching to gasoline this year. And why did they do that? South Korea's refiners had focused on diesel output because of strong demand for light cycle oil by Chinese buyers, which necessitated higher output of middle distillates. An average of nearly 1 million tons per month headed to China between June 2020 and May 2021, peaking at a record high of 1.31 million tons in March. However, the inflows fell to an average of just 170,000 tons between July to September, following China's move to impose punitive taxes on import of the product. In contrast, gasoline margins picked up from March, culminating in the front month 92 RON Brent crack averaging at $9.67 per barrel in October. This is the highest since at least June 2018, if not a record high, and daily levels hit 4-year highs of above $10 a barrel. Right, let's look at Japan. Crude imports to Japan hit a post-pandemic high of nearly 3 million barrels per day in October, rising from the Jan to Sep average of 2.39 million barrels per day, but still under the 2015 to 19 average of 3.19 million barrels per day, as emergency measures are eased and the peak demand season looms. Refinery runs likewise have also rebounded, averaging at 77.29% of its 3.46 million barrels per day capacity this year, up to for August and September, rising from the May to July average of 63.41%, but crucially still well under the 2015-19 average of 89.84%. From a yields perspective, gas oil output rebounded to post-pandemic highs in August and September, averaging at 2.73 million tons per month, recovering from the post-pandemic April 20 to July 21 average of 2.27 million tons per month, but remains below the 5-year average of 2.9 million tons per month. Similarly, gasoline output also rose to consecutive 8 to 9 month highs of above 2.8 million tons per month between August and September, recovering from the post-pandemic average of 2.63 million tons per month, but again, well under the 2015 to 19 average of 3.24 million tons per month. Likewise, jet kero output rose to consecutive 7 to 8 month highs of above 1.3 million tons per month in August-September, and again above the post-pandemic average of 1.24 million tons per month, but still well below the 5-year average of 2.06 million tons per month. So, despite the low runs, yields for gasoline and gas oil average respectively at 34.9% and 24.2% post-pandemic between April 2020 and September 2021, above the 2015 to 19 averages of 28.2% and 22.7%. In contrast, percentage yields for jet kero have averaged sharply lower during the same period at 12.9% versus 16% pre-pandemic, and fell below 12% between April and July this year. Yields improved to above 15% between December 2020 and February 2021, and are expected to rise again this winter, rising to 7-month high of 13.1% already in Feb. Japan refiners have kept runs low in the face of demand destruction due to widespread lockdowns, to the extent of being net importers of gasoline and diesel and minimize jet kero output. The colder than usual winter last December to this Feb led to post-pandemic high refinery runs and jet kero output, but even then, runs were not raised sufficiently, and Japan actually turned net importer for jet kero. With forecast for another colder than usual winter, and with the severe power shortages already globally, the impact on Japan could be even more severe this time round, particularly if runs were not raised sufficiently. All right, so what kind of final conclusions can we draw based on what we have discussed? Let's look at it from a product perspective. Well, let's look at inventories first, right? The uptick in demand in the face of tightening supplies have led to sharp falls in inventories of both middle and light distillates, falling to post-pandemic low levels after staying at above average levels for much of the pandemic. Middle distillate stocks, for example, in Singapore, are now at 10 to 11 million barrels per day since September, including falling to over 20-month lows of under 10 million barrels per day twice, below the Q1 2020 average level of 11.3 million barrels and the 2019 average of 11.13 million barrels. Likewise, the inventories for light distillates have also been on downtrend, falling under the Q1 average of 13.4 million barrels and the 2019 average of 12.7 million barrels, hovering between 11.5 and 12 million barrels currently. Okay, there's some capacity loss as well across the region. A total of at least 500,000 barrels per day of regional refining capacity will be lost in the next 3 years due to full or partial shutdowns that had been accelerated by the pandemic, following that sharp drop in demand for refined products that we saw in the early months of the pandemic. Oil major Shell, for example, will cut capacity at its 500,000 barrels per day plant in Singapore by half by 2023, and fully shut another 110,000 barrel per day facility in the Philippines. Fellow major BP has shut its 146,000 barrels per day plant in Kwinana, Australia in April, which was the country's biggest. This has led to a jump in 4.5 million barrels per day, just 4.5 million barrels of gas oil and gasoline imports per month. And how does all this impact each product market? Right, gas oil cracks, as we have seen today, have surged to post-pandemic highs averaging at $14.44 per barrel for October. This is the highest month average value since December 2019 and well above the 2019 average of $11.25. Diesel's entire 48-month forward curve structure is in steep backwardation of over $17 from a slight contango that we saw in the early months of the pandemic. This is mainly due to that perfect storm of demand recoveries as countries open up amid a lack of supply following China's clampdown and exacerbated by the severe power shortages globally. Gasoline is in the same mood. Its cracks to Brent have surged to a 43-month high, averaging at $9.67 per barrel, as we have seen, despite being well outside the peak demand season and well above the 2019 average of around $5 a barrel. And this is the highest month average since at least Jan 2018. Like diesel, gasoline's forward curve is also in steep backwardation of $22 a barrel through its entire 48-month curve, having been backwardated since just before the peak summer demand period in Q2. Gasoline supplies were already tight from the summer due to insufficient supplies, particularly from the US when the Texas deep freeze knocked out refining infrastructure, if you remember. Then came the hurricanes that damaged production infrastructure in September, as well as China's supply issues. Even jet kero cracks, which have been the worst performing product across the barrel, jumped, averaging at a 22-month high of $12.56 in October, though below the 2019 average of $13.24 a barrel. Jet kero's 48-month curve is also at backwardation at about $15 a barrel from a fully contango curve in the first 12 months of the pandemic. The power shortages amid the looming winter when jet kero demand peaks, the lack of supply and improved prospects for aviation as more countries are opening up has boosted jet kero. And fuel oil, well, we have not spoken about fuel oil a little bit, but because of the power crisis, I guess we need to talk about it. Balanced month, high sulfur fuel oil Dubai cracks average in positive territory of 29 cents per barrel in September for the first time in 11 months, as soaring gas and coal prices forced some countries to revert to fuel oil for power generation. HSFO's entire 48-month forward curve is also in steep backwardation of over $70 per ton in its first 18 months before flattening out thereafter. HSFO is the product most impacted by the power crisis that has engulfed the world, particularly since output has been sharply reduced globally following IMO 2020. So in final conclusion, the oil markets roared back to pre-pandemic levels because A, the spiraling global power crisis in the world's largest economy amidst the looming winter. Hurricanes wrecking production in the US that will not fully return till Q1 2022. China's move to clamp down on the overproduction of refined products. The gradual opening of the region's economies at the same time. India's festive Diwali season. Japan lifting emergencies. South Korea opening up upon reaching 70% vaccination rate. And many Southeast Asian countries opening up to travel. OPEC's decision, or OPEC's plus decision not to raise output beyond the committed 400,000 barrels per day per month. Oil's ability to mitigate the power crisis, which will worsen towards the winter before it gets better, is actually limited, as only fuel oil can be used as a direct large-scale replacement in most countries, with incremental demand estimated at about 500,000 barrels per day. By October, Bangladesh has actually abandoned plans to turn idle fuel oil capacities, while Pakistan did not award some of its latest tenders for November delivery cargoes. China is unlikely to change its policy of curbing overproduction of refined products in the near term. Hence, the supply vacuum that it has left behind will remain. Hurricane-wrecked U.S. infrastructure is expected to fully return only by Q1 2022, with oil major Shell declaring force majeure on some deliveries of the Mars grade till then. OPEC Plus is unlikely to sway from its decision to keep output increases gradual at the current 400,000 barrels per day / per month in the short term, though actual compliance has been falling, particularly from the likes of Russia and even the Saudis recently. And with that, I thank you very much, and I shall hand you back to Katie.
Thank you, Yeo-Chun. So we just finished on time. We will now go through the Q&A session. Quickly, there is one question. What can be expected from the OPEC meeting happening today in terms of oil output for meeting the recovering demand? Ranji, I think you might answer this question.
Yeah, thank you, Eddie. Can you hear me?
Yes.
Okay, perfect. So the meeting is expected to happen later today, and we are expecting the bottom line is that there is an increasing pressure that's coming from various players in the market, especially from the US, and recently India and Japan, they have also joined forces in putting the pressure to release more oil into the market, especially for the demand that each of them are facing, and also the high price environment that's been sustaining for the past few weeks or few months actually now. So that being said, OPEC has been quite vocal in terms of what they would want to maintain. And if we take a look at the kind of indications that has been given by the various energy ministers or the various representatives of the member countries in OPEC, they seem to be fairly comfortable with the supply-demand balance that they are expected to face in the coming months, and also the price environment that's helping them or favoring them at this point in time. And we also need to keep in mind, like we mentioned earlier, the current compliance rate is actually over than what has been allocated, which means even if they increase the volumes, there are very few producers right now in the group who would be able to ramp up and meet those levels. But that being said, most of those numbers, especially the Middle East countries like Kuwait, UAE, Saudi, most of them, they're very happy with the way the market is positioned right now. And there is no kind of influencing factor for them currently in order to go for those increased levels. The prices are good, the prices are supportive for their production numbers, their revenues that they have been looking at, and the balance the supply-demand balance that they would want to eventually achieve. Because one of the main pain points during the previous meetings was UAE wanting to increase their baseline numbers, that we knew it was a pain point in order to revise the baseline numbers. That has already been addressed, which basically from May 2022 onwards, the Saudi and Russia volumes are going to be increased to 11.5 million barrels per day. UAE baseline is going to be revised to 3.5 million barrels per day. Kuwait and Iraq are going to be increased by about 150,000 barrels per day each. So the main pain points for each of the member countries or the major member countries have already been addressed, while the members who are not raised a concern are already struggling to reach the allocated volumes currently. So there is no incentive at this point in time to change from the policy that they have kind of put in place, and we expect the 400,000 barrels per day to continue till April 2022.
Okay, thank you. And another one to finish. What is the expectation for oil demand for Asia post-winter?
Well, I mean, you have to look at it this way, right? Depends on how much the countries open up, how much travel we are going around. But I would expect that it would not be quite at the winter levels, but I would definitely expect it to be more than what it was, say, up till June this year, when most countries were still under lockdown. Vaccination rates in Asia were not high. So I would expect it to be better, but not quite immediately pre-pandemic levels yet. Yeah. Right. Back to you, Kathy.
Okay, thank you. Thank you to all of you who attended this webinar. Don't hesitate to reach your dedicated customer success manager if you have other questions. You will receive an email following this event. And see you soon. Have a nice day. Bye.
Bye, everybody. Bye-bye.
Yeah.